From the morning reading, the last of the major stock indices is about to give a sell signal. Sell signal in the sense is this time a death cross. When the 50-day average moves below the 200-day. When all four indices suffer these crosses, stocks tend to outperform, however. If we're operating under the theory that this is a sell signal for stocks, then results don't support that assumption. Returns to the S&P were weak in the shorter term of less than 1 month, though did not meet the test for significance. After a month, results improved significantly, and 3 months later, the S&P was higher 9 times out of 12, and only one of those losses was meaningful. It's useful to know what to ignore and what not to, and this one with the death cross is one to ignore. Further, stock started strongly but reversed to finish down on Friday, showing the kind of action typical of downtrending markets. The negative reversal, along with the 6th distribution day on the NASDAQ, was enough to shift the IBD's market outlook to correction. Individual investors should avoid buying stocks in a correction because the odds are now on the bear side. The NASDAQ is looking more and more determined to go down and test its own August closing lows, which are just above 4,500. Friday's ugly reversal developed despite 3 factors that could have been seen as bullish. First, after Thursday's close, Federal Reserve Chair Janet Yellen said that rates would likely rise sometime later this year. The Federal Reserve's September 17th decision not to raise rates left some on the street convinced that the Fed lacks confidence in the U.S. economy. Economic data provided a second piece of potentially bullish news Friday. The final number for Q2 GDP growth came in at 3.9% stronger than expected. And then the third piece of news was the House Speaker Boehner announcement that he was leaving Congress at the end of October. But it wasn't clear just what made the market made of all of this. Okay, now finally we have October. This coming Thursday will mark the start of October. As you well know, some of the worst market drops have taken place during that month. That bad history is balanced, however, by the tendency of October to mark the bottoms of downside corrections and bear markets. In other words, it's a crucial month. It appears likely that the start of October will witness the test of important support levels around the summer low. What happens from there will tell us whether this will be a good or bad October. You're all aware of the sell in May and go away maxim, which worked well this year with the S&P peaking in month of May. According to Wikipedia, that maxim is only the first half of the so-called Halloween indicator. The second half of that indicator says to come back around Halloween. That saying is based on the tendency for stocks to do better between November and April, according to the Stock Trader's Almanac. We'll have to wait and see if the second half of this indicator works as well as the first half. And speaking of seasonality, a couple things you have to keep in mind on the bigger picture. President's cycle is still favorable for seasonality, but we are also in the worst 6 months for this effect. So it is some pretty interesting crosswinds that are coming into play from a big picture seasonality standpoint. Well, that's it for the morning reading. So, hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:01 a.m. Central Time, and I'm recording this in preparation for the market day of September the 28th, 2015. Full disclaimers at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our overnight action. Take a look at the morning report. On the 4 broad market indices, we are pretty significantly down, and the interesting thing is the overnight range. You notice here 26-point overnight range. So it was at one point fairly significantly up, and we've had a big reversal. Now we've got considerable weakness. On the S&P, we're down about 10.5 points, or about 0.5%. The Russell's down about 0.4%. Nasdaq's down over 0.5%, as is the Dow, also down over 0.5%. Crude oil down 1.7%. Euro down just a fraction. And then bonds up about 0.5%, and gold down over 1%. In overseas action, Asia relatively quiet, at least from the China standpoint, up about 0.25%. Notice Hong Kong, this date 9/25. It would appear that Hong Kong's markets were not open last night. Japan was open and was down about 1.3%, and then Europe pretty weak. Germany was down about 1.5%, as was the United Kingdom. In terms of macroeconomic reports for today, you have FOMC member Dudley speaking early today, and then you have core price index, personal spending, and pending home sales all coming out today. And then later today you have FOMC member Evans and Williams both speaking at separate engagements, it would seem, certainly well apart on the timing. In terms of tomorrow, let's see, for the United States, you have goods trades balance and consumer confidence. That'll be a big one right there, consumer confidence. So that should take care of us for today and tomorrow. In terms of the current volatility conditions, short-term VIX almost a 23, skew almost to 135, which should be a full-out warning level. IV percentiles 41, 39, 40, and 47 across the four indices, so they're all below the annual average, so keep that in mind. While certainly these numbers have been elevated in the last 4 weeks, they're certainly not super hot. We only had one market with a standard deviation move put in on Friday, and that was the Russell, though there was quite a bit of intraday range on that. In fact, let's go ahead and take a look at the chart. The SPX, we're kind of in a no man's land right now if you kind of focus on this. Obviously we had the big fall, we had the pennant or ascending triangle with the false breakout post FOMC, rejection, rollover, then a very important rejection candle, because not only did it confirm this rollover but then close below the diagonal support, followed by a little bit of a bounce coming into the backside of the diagonal, and then weakness from there. And indeed you have 1, 2, 3, 4, 5, 6 out of the last 7 trading days have been negative. We had a big long tail put in on Thursday, and indeed from Thursday's action, which I believe was the low, is on the ES, was just below 1900, ES being the S&P futures contract, to its high around 1951 on that contract. You had like a 50-point swing, but when it was all said and done, all that bullish action practically was given up. Market on Friday dropped about 40 points from its high on the intraday, and then closed slightly up off the bottoms, leaving us with this relatively indecisive candle kind of in the middle of no man's land. So here we are, we've broken down, but are with this kind of action here, some evidence of bullish, some evidence of bearish, a big old kind of spinning kind of body there. Are we going to first see a return to the area of the previous swing lows, or will the bulls be able to muster some momentum that has thus far been lacking and take us back up into this area here? Right now, it looks like this broken down pattern here is starting to look more like a new range. And you recall, of course, we spent months earlier in the year in a range-bound market, and then prior to that, actually, if you go back, there was a prior range that goes all the way back to November. So we've basically been in 2 ranges since almost a year ago, and this one starting to take the shape of a new range. So we'll have to see where this comes in. There's just there's not a lot of edge here at all in terms of initiating positions. Even if you're a short-term aggressive trader, not a lot of advantage to this pattern right now. Russell, very much the same thing, but probably more bearish, and certainly that's not an indecisive candle on Friday for the Russell. NASDAQ has been more bullish in a relative sense, and that this was more, this really wasn't an ascending triangle or a pennant. It really was more of a wedge, and that wedge did indeed break as it was expected to the bearish side, and very, very bearish action on the NASDAQ on Friday as well. So not good when you have your growth leaders of NASDAQ and Russell that are so bearish in their action. On the Dow, held up relatively better on Friday, but still kind of in this no man's land, and really we're starting to look more like we're again denigrated into a range bound market. So let's see here. Let's bounce back to our daily report. We do have some important changes on the daily report at this point. In terms of our portfolio investor posture, the IBD status has fallen to market in-correction. So full out warning, and I mentioned in the morning reading, market in correction, not recommended to be in positions, and certainly not initiating new positions. Accumulation distribution, S&P is at a D-, NASDAQ at an E. GMI index agrees with IBD status in that it's also a full out sell signal. Primary market condition is strong bear. Stock charts, lots of down arrows across all the different time frames, across each of the markets. In fact, if you put all this together, the consensus is obvious. It is a very, very bearish condition, and certainly not conducive to being able to take on new positions. And indeed, position sizing opinion, I did not update this one. This should actually be a 0 for portfolio investor position sizing opinion, and from a volatility base based on the VIX, it would be at a 50%. So pretty light from those opinions. On the intermediate term market posture, outright bearish. The S&P at 31.9 and sloped down. Dow 43, Russell 31.3, and then NASDAQ in a relative sense holding up the best at weekly bearish at a 56.9, but if that falls below a 50, that will also join the other three markets in a bearish intermediate term market posture. Hedge warning status, we've increased this half a notch. This is now a 2+, which is a red light. Risk levels significantly elevated, and as such, not a great market to be initiating new bullish positions. This, of course, does not predict that we're going to fall or how far we're going to fall, but it does say that risk conditions are significantly elevated, and such conditions are quite conducive to significant falls in the market. From the volatility base, you have a number of warnings. Market in decline has warned. We're VIX above an 18. Distribution day count has now reset and will stay as in reset condition until we get a confirmed uptrend, and I'm not sure how long that might take in this current market. Skew is above a 130, not above a 135, so elevated but not full out warning status. Look at this, new highs, new lows. After that big reversal, we did put in over 300 new lows in the New York Stock Exchange, so that hit warning status. Intermarket risk aversion indicators, all 5 are now risk off. In terms of special opinions, option income strategies, VIX is outside the acceptable window for novice traders. Highly experienced traders may find the premiums available in these elevated volatility conditions very exciting and acceptable, but you need to be somebody who is well versed in adjustments and other exit strategies, and then at the same time being able to account for both significant changes in delta and vega. In terms of covered call strategies and put selling, These conditions are only very borderline acceptable to initiate new positions, and keep yourself very much on the sidelines in terms of this current market posture and condition. Consider reduced position sizes, consider legging in, using a put selling leg into the covered call. Consider for put selling, use spreads to define that risk, and consider scaling into full positions even if you are an aggressive trader. So while volatility can certainly bring on the plus side opportunity to get nice premiums, if you are more of a bullish swing and certainly core portfolio, and you love to sell puts and bull markets and so forth, this is not the time to be exercising those muscles. Better to protect your capital and reduce your exposure in the current market conditions. In terms of sector specific market posture, sea of red here. Utilities, of course, is an exception, though utilities, remember, can be very sensitive to interest rate changes, and those are still looming. So this is probably a short-term window of opportunity. And obviously we've seen a lot of red on the percent change, and if the market does decide to fall to that side, utilities will go down just like everything else. And look at utilities for the year to date and the 1 year. Even though that sector has been at times very, very strong, especially in 2014, it will absolutely get swallowed up in a down market just like everything else. And while these numbers aren't as bad as, say, energy at minus 32% in the 1 year time frame, a loss is a loss, and protecting your capital is paramount in this current market condition. So that should be enough for that. Let's see here. Well, we do have a special announcement for today. We are working in collaboration with the Chicago Northwest Burb Trading Club, and in that capacity wanted to announce the availability of a new course, 40-hour course for self-directed active money management. This course will consist of a 10-week, 4 hours each session, plus some bonus material. It'll be actually 43 hours of educational material. This is the 9th time this course has been taught by my friend Nick Fosco. The purpose of this course is to cover topics of interest to self-directed investors and those seeking to trade for a living. It will start on Saturday, October the 10th, running each of those sessions from 9 a.m. to 1 p.m. weekly. And this will take place in the Chicago suburb of Schaumburg, but will also be simulcast to the web for those who are not able to be there in person. So it doesn't really matter whether you're in New York City or the western Chicago suburbs. You can have access to this course if you'd like. If you'd like the details and get the particulars on the course syllabus and all those kinds of things, go to the website here that's indicated and sign up through that website as well. So very neat things going on there with the Chicago Northwest Burb Trading Club. In terms of the morning market preview, obviously if you like what you're getting from here, we greatly appreciate you showing that appreciation by retweeting us to your Twitter followers, to your StockTwit followers, liking us on the YouTube, subscribing to our YouTube channel. All those things are very, very helpful. Feedback can be sent to support@falconglobaltraders.com. More information is available about what we do in the Falcon side of things at this website. Disclaimers as always. Hit the pause button if you need more time to review this. And we look forward to seeing you back here tomorrow morning for the market preview from Falcon Global. Good trading.